Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TECHTRONIC Industries Company Limited Annual Report. TECHTRONIC Industries Company Limited offers a diverse range of products and services across various segments. The company's power equipment segment provides power tools, outdoor power equipment, and storage products to consumers and professionals worldwide. This includes gas, corded, and cordless equipment for both residential and commercial use. In addition to power equipment, the company also operates in the floor care and cleaning segment, offering a variety of cleaning solutions such as cordless cleaning products, carpet washing products, and vacuum cleaners under well-known brands like Hoover, ORECK, Vax, and Dirt Devil. The company's product portfolio is further complemented by equipment, accessories, hand tools, safety solutions, and outdoor products. TECHTRONIC Industries also engages in research and development activities to stay ahead of the competition and invests in various holding activities to expand its business reach. With a global presence across home, construction, maintenance, industrial, and infrastructure industries, the company serves consumer, professional, and industrial users worldwide. TECHTRONIC Industries Company, limited market capitalization of $192 billion, is significantly larger than the average industry peer of roughly $11 billion. This shows that TECHTRONIC Industries Company Limited holds a significant advantage in their industry. TECHTRONIC Industries Company Limited trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 3.52 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.52%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, the Milwaukee brand has been a significant contributor, with a 7.9% increase in local currency. The RYOBI brand has also seen growth, with a 5.4% increase in local currency. Strategic acquisitions have created opportunities for growth and synergies with existing core businesses. Additionally, diversification into new product categories, such as lifestyle and recreation, hobby and craft, and cleaning has contributed to revenue growth. The company's success in expanding its cordless installed base and gaining share in the market despite modest U.S. housing turnover are also notable drivers of growth. Strategic investments in new products and technologies have further fueled revenue expansion. In terms of specific numbers, the power equipment segment saw a 5.3% increase in revenue from 2024 to 2025, while North America and Europe experienced increases of 3.2% and 13.3%, respectively. On the decline side, non-core businesses such as Heart and Floor Care have been significant contributors to revenue decline, with a minus 20.4% decrease in local currency. The voluntary exit of the Heart business and continued rationalization of the Floor Care business have also contributed to decline. Weakness in brands such as Hoover, Dirt Devil, ORECK, and Vax has further impacted the company's revenue. In terms of specific numbers, the Floor Care and Cleaning segment saw a 9.7% decrease in revenue from 2024 to 2025, while other countries experienced a 2.5% decline. Net income experienced a mixed trend over the 2-year period. Initially, it increased by 6.8% to reach $198 million. However, this growth was short-lived, as net income decreased by $42 million from 2024 to 2025. Profit margins showed significant improvement across various categories. The gross profit margin improved by 91 basis points to 41.2%, primarily driven by the expansion of non-US businesses and entry into new end-user verticals. Additionally, the EBIT margin increased by 7 basis points to 8.8%. Despite these improvements, operating profit margins were not specified in any page, leaving a gap in understanding this particular metric's performance. The company's financial performance has been a subject of interest in recent years. According to the provided data, the company has consistently generated positive operating cash flow. This is evident from the figures mentioned on page 106, which show that in 2025, the company had an operating cash flow of $1,979,181, and in 2024, it was $2,267,646. These numbers indicate a steady increase in the company's ability to generate cash from its core operations. The fact that both years have shown positive operating cash flows suggests that the company is managing its finances effectively and has a solid foundation for future growth. Overall, this trend bodes well for the company's financial health and stability. The company's debt level has undergone significant changes over the past year. While there are instances where the debt level has decreased, such as a total decrease of $549,100 from $5,920,471 in 2024 to $5,371 in 2025, and a net debt increase of only $744,797 from -$44,391 to $700,406. Other sections indicate an overall increase. For example, the maximum exposure to credit risk has increased by $454,324,000 from US $3,254,537,000 to US $3,708,861,000. In terms of interest expenses, there is a general decrease observed in some areas, such as a net interest expense for the year amounting to US $34 million, which is a decrease from US $54 million in 2024. However, on page 157, it is noted that interest expenses have increased significantly, with non-derivative financial liabilities interest expense increasing by $823,868, and lease liabilities interest expense increasing by $781,610. Overall, the company's debt level has experienced mixed changes, while interest expenses have generally decreased except for significant increases in certain areas. The performance of various segments and regions within the company has been mixed, with some areas showing significant improvement while others have struggled. In terms of segment performance, power equipment was a standout, with revenue increasing by $725,826 from 2024 to 2025. This growth was accompanied by a notable increase in profit before taxation, rising by $86,088 over the same period. In contrast, floor care and cleaning experienced a decline in revenue, dropping by $99,905. Regionally, Europe EUR performed well, with sales denominated in EUR increasing by 23.2%. Conversely, the US dollar segment struggled, with purchases denominated in US dollar decreasing by 16.9%. These results indicate that while some areas of the business are thriving, others require attention to improve performance and drive growth. The company has a history of paying out dividends to its shareholders. According to the financial reports, in 2024 and 2025, the company paid out significant amounts in dividends. In 2024, the total dividends recognized as distributions during the year was US $572,651,000. This amount is also reflected in the dividend payments made by the company, with a total of $486,103 declared for 2024. In addition to paying dividends, it can be inferred that the company has not bought back shares, as there is no mention of share buybacks in the provided text. The focus on dividend payments suggests that the company's priorities lie in rewarding its shareholders through cash distributions rather than repurchasing its own stock. There are concerns about inventory buildup in the company. The total inventory has increased from $4,076 million to $4,452 million, indicating a significant rise in stock levels. Furthermore, the inventory days on hand have also increased by 4 days to 106 days, suggesting that the company is holding onto its inventory for longer periods of time. This buildup can be attributed to the increase in finished goods and raw material inventories, which have risen by 3 and 1 day respectively. These trends suggest that the company may need to reassess its inventory management strategies to prevent further accumulation of stock. That concludes the financial summary for TECHTRONIC Industries Company Limited. Feel free to comment below, and I will be happy to answer them when possible.